Good morning. This is Jim Colburn of Commodity Research Group. I'm with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. You can check us out at our website, commodityresearchgroup.com, where we post our podcasts and blog. We'd like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check them out at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is October 16th. Good morning, Andy Lebow.
Good morning, Mr. Colburn.
As usual, we have a lot to talk about. So let's get right into it. Last week, the big three, the EIA, the IEA, and OPEC all released their monthly oil market reports. And the market seems to have a fixation with demand numbers. So why don't you summarize what came out and what your thinking is?
Well, demand has definitely been a overriding factor, particularly over the last 6 months to this market. Maybe longer, Jim. As you said, the big three came out and they all pretty much shaved demand again, which has been month after month. I think we've been saying, hey, I think these demand numbers, these estimates are too high, particularly for the IEA, and they have decreased demand based on the expectations that because of one can almost say a recession in manufacturing and uncertainty about trade, petroleum demand is directly affected, and as a result of the economy. Or concerns about the economy, demand has been shaved, a couple of 100,000 barrels a day almost in each report, maybe even more than that. The IEA I think they've got 1 million demand growth for 2019 and 1.2 for 2020, but that is with a 1.6 million barrel per day demand growth in second half, which we said in our last podcast. Yeah, I think that's too high, and
right.
They'll end up shaving that as well.
You still feel that way, right?
Yeah. I still feel that way. OPEC 2 reduced its demand as did the EIA. Marginally. It's amazing though that even though these forecasts are shaved by maybe 100 or 200,000 barrels a day, the market still has a spasmodic reaction to negative news, and we see in the headlines fears about trade and economy is a reason why the market is down $1 or $1.12. We saw that earlier this week.
Yes.
So some down days, and now we're holding in right now at 52.50.
So with those demand numbers, well, let's just backtrack a little bit. And do you want to just bring us up to speed on what OPEC, obviously a big story last month was the attack on the Saudi oil fields. What's the update with OPEC production?
Well, we certainly have, last month during our podcast, I think it was, when did we do it, Jim? Like the day or two after that attack?
Yeah. The
market was up over 62.50. Brent was WTI was up over 62.50. I think Brent was over $70 at that point, and it was, it was unclear as to how quickly the Saudis could get 5.7 million barrels a day back onto the market, and incredibly, it was a 2-week affair, and certainly that's one of the reasons. The main reason, as well as this overriding concern on the demand side as to why the market has sold off so dramatically from the highs. And in terms of OPEC, they have a big challenge. They have an enormous challenge actually for next year. It looks like, we always talk, Jim, about the call on OPEC crude. It's it's like the one number you could look at and figure out, where is the market balanced? Is it too long, too short? Sort of like, I guess, war in baseball, or what is it in basketball? PER.
I think, and Andy, I think even with those numbers, I think we're showing our age. I think they're way beyond those now.
But, they're way beyond those. But I think if you were looking at like one
right. Yes.
That you had to go with it, how good a player is.
Yeah.
I think it's WAR and PER. But for oil analysts, it's call on OPEC crude, which is the one number that you look at to see. All right, well, if the call is X, what does OPEC have to produce to balance the market or have inventories draw? They obsess about, OPEC itself obsesses about it. It's where they want to, they target their production based on what they think demand for their crude is going to be. And it looks like in third quarter, because there was a 5.7 million barrel a day loss in Saudi crude for 2 weeks, OPEC production was down for the quarter was down to 29.3, and the call based on the average of the big three was like 30.7. So it looks like we drew stocks in third quarter. Probably not that much, probably not 1.4, but there was definitely a decent stock draw, I think, in third quarter. Now, fourth quarter looks a lot more balanced. The call on OPEC crude is about 30 million barrels a day using IEA, EIA, and OPEC. And, OPEC production is probably going to come in around 29.7, 29.8 this quarter. So, we look balanced to a surplus. Now, these are the two big numbers that is why the market is really on the defensive, and where OPEC has its challenge. If you look at first quarter call on OPEC crude using the big three, it's 28.9. So, and the IEA is something like 28.2. They're really low. So if OPEC's producing 29.7, we've got a pretty big surplus in first quarter. Second quarter isn't a whole lot better. It's 28.7. So, again, you're looking at a big first half surplus, and that's what, the market is really, why the market's on the defensive, why it's really concerned, why the IEA keeps saying, OPEC really has a challenge for the first half. And, OPEC knows it. And the other problem, of course, is now where you get this call on OPEC crude, it's basically supplies, global non-OPEC supplies plus OPEC NGLs minus demand. Well, if demand is really, if demand is a lot softer, it means the call on OPEC crude is going to be a lot softer. So, again, they're already up against it for the first half, and they know it. I mean, this is no big, this is no big revelation, but they are the most important numbers in the market right now.
Just to backtrack, I just have a question. You could say yes or no, or we don't have to answer. But you think about the Aramco IPO. Does what happened last month make you more willing to invest in that once it becomes a stock, or less, because they recovered incredibly quickly from a major attack on their oil fields? So that would say, wow, these guys are really good. On the other hand, there was an attack on their oil fields, so
right.
These guys, they're really vulnerable, or they're more vulnerable than we may have.
Well, one would expect that they are tightening up on all vulnerabilities, right now, and I think Aramco's coming out at a time where the oil stocks are way out of favor. There was an interesting article about how the oil index, I think it's the XLE, has vastly underperformed even crude prices, even the outright WTI price or the Brent price,
Right.
and that's for that's for a variety of reasons. I think the
Yes.
investment world is just not very enthusiastic about this sector, quite right now.
Right.
That certainly could change,
And
as
your
we know.
and your commentary so far has been the sector has vulnerability to downside moving price from here.
At least in the short term. And now one has to wonder, how much is already discounted into the market. We've got an OPEC meeting coming up, and assuming let's say demand falls another 200,000 barrels a day next year, or 300,000 barrels a day. I think OPEC is looking at bigger cuts, somewhat bigger cuts, and the Saudis, certainly want to keep. I think the Saudis are going to want to keep the market somewhat steady, if not, their goal is certainly higher. I mean, their sweet spot for their budget, is $70 to $80 Brent. So we're far from that. And the other thing, Jim, is we still haven't had any meaningful retaliation for the attack last month.
Yeah.
I guess they did I guess they did some computer, the mass, or at least they tried
Some hacking.
some hacking, but I still think we can await. I do believe there'll be some type of response.
So, Andy, I just want to bring in my world a little bit. What we haven't seen is aggressive put buying, say, in that first quarter. I mean, I look at the volume numbers and I see much more subdued total numbers, maybe around 100,000 or so. And then also I've seen days where there's just been a dearth of put trading. It's been like sometimes 3-to-1 calls to put. So that tells me, and again, I don't see the paper flow going through my grubby hands like the old days. But I think what's happening here is that there's upside call buying to protect against, it could be market makers, putting a little upside protection should, some kind of retaliatory event occur. But I don't see the fear of the downside coming out with lots of puts trading. So maybe that's, I don't know. Maybe they're already, like Mexico. Maybe they're already covered for 2020.
Yeah, maybe how much is already discounted into the
right
into the price here. One has to assume that a lot of these numbers are already discounted. It's just a question of, are they going to get better? Are they going to get worse? And, we also still have the winter ahead of us, and as you were remarking earlier this morning about a comment by Spencer Dale, how important weather was to demand.
Yes. I saw him at a conference earlier in the year. He's talking about I guess it was a GDP and weather as the main determinants of demand, and also price. Throw that in there as well. Yeah, and also, Andy, are we take the U.S. situation? We have we had this Hurricane Barry that put a little lid, shut in some production. I mean that storm kind of hung around a little longer than these storms do. I think it was for a couple of weeks, right? And took off 1 million barrels of oil. And it wasn't just the shut-ins, but the terminals, I think, got shut down as well.
Right.
And so, now we're coming back. I think we got something like 12.7 in the latest weekly. Is that? I mean, I think that's numbers correct.
It's 12.6.
12.6. Okay,
yeah.
12.6 of production. And like you said, the surge is on its way, or the the fourth
Well, this
quarter.
is it. I mean, you look at the June numbers, even before Barry, I'm looking at the monthly numbers right now, it's 11.86.
Right.
So now we're
Yeah.
at 12.6.
Yeah. So
One,
it's,
2, 3 months later, we're at 12.6.
but also, we're in turnaround season, and we probably have runs down. I mean, there's some unanticipated
Right,
outages as well, right? So,
right.
so we're kind of like in this. We're getting more supply, and demand is down. So, what do you think about the idea that as we come out of turnarounds, we're going to be, because I think we drew from May to August, we drew a lot of
Right.
barrels. So, I mean,
Yes, we did
are
after
we
a
going to?
big build.
So you don't see that, once the turnarounds end and the outages come back, you don't see that. You continue to see builds in inventories.
I do because, let's talk first of all on the production side. What the and this is going to be really important for the market, actually, for the global market, is we're at 12.6 now. The EIA is looking for 12.95 in November and 13 in December. So they're saying that, right, that U.S. production is going to grow by 400,000 barrels a day over the next 2 months. And then, in the first quarter, pretty much plateauing right around, not plateauing, but right around 1305, and second quarter 13.1, which is still, that's still 500,000 barrels a day from where we are now.
Mm.
So the key is, what's going to happen to these barrels? They're going to have to be exported, or inventory, or they're going to have to, or they'll go into U.S. inventories. And
Sorry, go ahead.
no, and I think what we also mentioned about, in our last podcast, well, the curve was spiking like crazy
Right.
at that point. But I think we had, maybe it was the podcast before that, Jim, when
Yeah.
the market was pretty well backwardated, and both of us were like, I don't know,
Yeah.
whether that backwardation could sustain itself. And it's really, I mean, it's completely come off. The front month is now contango, and Dice Red Dice is, I don't know, 10 cents a month, maybe, 15 cents a month.
Yeah. We talked about how what we saw in the EIA production projections for stock levels not jiving with what we were seeing in the back month to 2020 curve. And we had actually been seeing some, I don't know if it was just one trader, but somebody building a position, and looked like the $1.50 calls in the spread options back in 2020 as well. So
Right.
those, like $1.50 calls were building open interest. So it looked like some people were doing that. But my question is,
You think they were, in retrospect, there was that selling? You think the position was short those calls? The hedge
it's a good question. You never know.
I know you never know,
who
but
initiated it? I usually those kinds of positions are initiated by the buyers.
yeah,
You don't
that's
see
right.
somebody
Yeah,
putting on a big. Now, on the put side for the spreads, it could be sellers, because those are the people with storage
right.
facilities hedging their put option. Anyway, my question was takeaway capacity in the fourth quarter. I mean, that's a big surge. Is it? I mean, I assume you don't produce unless you have a pipeline, right? It doesn't.
No,
That's the way it works.
yeah,
Right?
really. No, I think, well, pipeline capacity is growing significantly, to the point where there's not going to be, it doesn't look like there's going to be a tightness of capacity, like we saw last year, when these spreads, when the Permian to Houston and the Permian to WTI spreads, pretty much collapsed. But it looks as though for fourth and first quarter, we should be okay on pipeline capacity. The question is going to be, these barrels going to, I guess it'll depend on what the price is. Will they go up to Cushing? Will they go to Houston? And if they go to Houston, are they going to be stored or exported? And that's going to depend obviously on where the arbs are and where the curves are. But at least according to the EIA, there's a lot of U.S. supply on the way in the next 4 to 6 months,
And
then we have to figure out what to do with it.
I was going to say, based on past performance, we believe that those are good numbers.
Yeah. Based on they've for years they didn't get it right. The EIA,
they underestimated.
They underestimated it.
Yeah,
maybe this is somewhat overestimated, but we'll see. I mean, we're getting close to this fourth quarter surge. We're in the fourth quarter. We're in but it's the November-December surge that we're almost right there. We'll see where these numbers come in.
So I guess a question. We were talking about indicators. You were talking about the call on OPEC crude, but the famous desert island. If you're stuck on a desert island, would say the 4-week average of U.S. crude oil exports be one of your desert island indicators?
I think that would be, that's an important indicator. These ARBs are going to be an important indicator. Clearly, the number one number is going to be U.S. crude production.
Right.
The week to weeks. Well, right. That's harder to do because they base it on the short-term energy outlook that was just released, which is not the short-term energy outlook. I think on the on the short-term energy outlook. I'm sorry, the petroleum supply monthly.
The monthlies,
monthlies,
which are delayed. I mean, they're lagged.
They're delayed, right? They're lagged.
So we look at the weekly production numbers, which are basically a model they use, and then they chew them up with the monthly. So we're in October. The end of October, we get the monthly supply report, and that which production number will that be? That would be September's.
That's September's
number. So it's and then they chew up
the end of the month.
Got it. Yeah. So
that's going to come out the end of October, and then that it's either August or September.
Yeah, and they now round those.
Yeah, and they round those.
I mean, they round the monthlies. I'm sorry,
the weeklies.
They round the weeklies, which drives us crazy. But it's true. You have to do that. You can't. They say the economists have a sense of humor because they use decimal points in their estimates of GDP, and that's kind of they're showing us that it's a number that they're estimating, and it could be they can't call it that close, basically.
Right.
So we will trade off of these numbers, but they may or may not be totally accurate. So.
Yeah. The last monthlies were July. Were July data, so the next monthlies are going to be August data, not September data.
So, Andy, we had in the news there was talk about China. Was it Sinochem talking about maybe cutting runs because of shipping? The U.S. put some sanctions on their ships,
right?
And shipping rates have soared, and it costs more to get crude into the country, and they're looking at cutting runs. You want to just
another bearish. There's another very bearish factor for the market is on the on margins have really been hit because VLCC rates have just skyrocketed, not only because of the sanctions that the U.S. has put on the Chinese shipping company, but also the PG rates. Persian Gulf rates have gone crazy because of the risk of going into the Persian Gulf. So here, and maybe this is another reason why, the sector has done so poorly on the equity side. Refiners were really hoping for a fourth quarter and first quarter bounce on their margins, based on the upcoming IMO 2020 change in shipping fuel, which is for a lighter fuel, and would help their margins. So right at the same time, what's happened? That one of the big costs, the shipping costs have just skyrocketed,
So,
by multiple dollars per barrel,
so this will
five,
help,
$6, $7 a barrel.
but this will help U.S. refiners, right? Because they're getting domestic crude. You don't have
It
to.
should help. Yeah, yeah. It should definitely help U.S. refiners. And in fact, the cracks have been pretty strong, probably owing to expectations that diesel stocks, Jim. Let's talk about distillates. I mean, distillate stocks are just outright low right now.
Mm-hmm.
They're at 127 million barrels, which is 26 days supply versus a 4-year average of 141, which is a 29-day supply. And they're particularly low here in the Northeast, where we actually, we still use heating oil here. So,
Right.
you get a cold winter or an early. We always talk about the early, late winter, but you get some cold weather into November and December, and diesel. You've already seen. I mean, diesel cracks are doing really well. We get a cold winter, and that's going to remain pretty robust. So yeah, maybe U.S. refiners certainly are advantaged to a certain. Yeah, they're certainly advantaged. So when we're seeing it on these margins, the Asian margins though are we're not seeing that, and then certainly China's talking about cutting runs, which should be bearish crude and bullish refined products down the road. It never works that way, but
Yeah, that's the theory.
that's the theory, right?
Let's talk about prices, Andy. Let's talk about crude oil. So you just painted I think, a bearish picture going forward. Now some of that's already in the market.
Right.
So going forward, last year we had a tumbling market. I think maybe exaggerated as some oil company was liquidating positions in a thin market. But
well, we also had a macro puke.
right, we did. That's right. That's right.
Which we participated in.
I'm gonna quote you on that phrase, macro puke. That's a good one.
Well, there was,
Yeah. No, I
market,
know.
the stock market, the equity markets were, just getting pummeled.
Yes. So going, it's October. What do you think going into the end of the year here?
Do I think? Well, I do think that we'll probably see some production cuts coming out of OPEC. I do think that we're going to, again, it's hard to predict on what type of retaliation this and when the Saudis are going to, where that goes. Do I see the market possibly getting under 50? It's possible. I mean, we're at 53 right now, so yeah. I mean, WTI could inch further below 50 without an OPEC cut. Yeah, I think we will be below 50. And on the upside, we've been saying we like the return maybe to upper 50s to 60. Now it's looking more like the equilibrium price has been 55. Yeah, I could still see. Again, let's talk about weather. I think we can get back up over 55, 56, 57. 60 is going to be a real reach.
And I'll ask you this, but what about the volatility around this market? You think it's going to keep the implied vol yesterday is around 37%. This is based on the second nearby. September 16th, that would be the Monday after the Saudi attack, was 46.4. And then September 13th, it was 32.3. The high of the year so far is January 2nd, 53. So you see, who would have expected a Saudi attack on the oil fields on fire, and it's not the high vol of the year.
Right. That's unbelievable.
Yeah. I blame the millennials, but that's
we blame them for everything, right?
Of course. But my point is this 37.1 is a little higher than average. That would be the at the money second nearby December. So there is a little bit of a volatility expectation in there that's higher than average. So I guess that's kind of in line with what we've been seeing. Tweet orientated
Right.
possibility of retaliation, and we got possibility of lower prices. So just
Right.
not seeing it in the volume.
Yeah, we still have 37. Yeah, maybe it could dip a little bit further, but again, what are we talking about here? We're talking about an OPEC meeting coming up. We're talking about this. It still isn't as though the Iranian Saudi situation has been resolved. We have that coming up.
Right.
So and maybe that's why volatility, given what the price action has been over the last 10 to 15 days, maybe relative to that, that's why vol is so high. It's tough to sell with some looming events.
And China demand.
You agree or disagree?
No, I agree. I think it's pretty well priced. I'm surprised again at the sort of the dearth of put trading. It's almost. I looked at there's a website called Barclay Hedge. It doesn't have anything to do with the bank. BarclayHedge.com, and they track CTA, money under management, assets under management for CTAs. And I'm not sure how accurate it is, but I just tracked the changes, and that's been down. So this year, so it's possible that what it was, the option market has lost some sort of fund or speculative activity, and maybe that's what I'm picking up here. But I just thought you'd see more puts trading over calls. But again, Saudi oil field on fire. People are
right.
You haven't forgotten that.
That's not resolved.
It's not resolved, exactly.
And again, there is an OPEC meeting
coming up. So yeah, I guess it doesn't make a lot of sense.
These trade talks. It has that's definitely had an impact on petroleum demand. I certainly the uncertainty as well as actual shipping costs have gone up, but I think demand for transport demand is probably relatively probably softer than it could have been.
Right.
With had we not had these trade wars.
And then cracks, you think you mentioned it's a little bullish.
We're in turnarounds right now. The IMO is coming up, so as of January, so there could be some dislocation there, and I'm sure there'll be plenty of confusion. So cracks, and we have the global winter coming up. So I think margins. I think they'll stay steady to maybe higher here coming up. Again, shipping costs are different. That's a whole different thing. The crack doesn't quite take into account for that.
So we covered a lot. I'm sure we didn't cover it all. Anything you want to add to this?
I think we caught. Yeah, I mean, we definitely covered. We covered the NBA, Major League Baseball.
Right.
The Saudis, and yeah, we did cover a lot, Jim.
Okay, great.
The only thing I'd have to add is if you're, interested in learning more about us, check out our website. Jim posts pretty much every day some really interesting stuff at commodityresearchgroup.com.
Terrific. And Andy, we also have a presence on LinkedIn if anybody wants to connect with us, where we just say yes to everybody, right?
Pretty much. Yeah, everybody.
Yeah.
We're easy.
It sounds good.
And not selective.
Very good. We'll see you next month. This is Commodity Research Group signing off.